Hey everyone, welcome back to Corporate Decoder, the place where we decode the jargon so you don't have to. And today we are diving into Breeze Acquisition Corp. I asked -1 filing to see if this special purpose acquisition company is setting sail for success or about to hit an iceberg. Now, this is an S-1 filing, which means Breeze Acquisition Corp. The C is planning to go public, and they are doing it with a bang, offering 12.5 million units at $10 each. That is a cool $125 million offering before they even find a company to buy. But what exactly goes into an S-1 filing? Well, it is a detailed roadmap of a company's plans, its risks and its leadership all laid out for potential investors. Think of it as the company's resume and danger manual all rolled into one. So Breeze Acquisition Corp. Second is a blank check company. That means their whole purpose is to find another company, merge with it, and then that combined company becomes publicly traded. They have not picked a target yet and have not even started serious talks. This is a classic SPAC maneuver. The filing tells us the company is based in the Cayman Islands, which is a common setup for these types of entities. And who is at the helm of this venture? We have J. Douglas Ramsey, PhD, as Chairman Chief Executive Officer and Chief Financial Officer. He has a lot of experience, having been involved with another SPAC called Breeze Holdings Acquisition Corp, which successfully merged with YD Biopharma Limited. That is a good sign right there, seeing that the leadership has navigated this path before. The team also includes other experienced professionals that you can read about in the full filing if you are interested. Alright, let's talk about the elephant in the room, the risks. And boy, are there a lot of them with a SPAC. The main one is that they might not find a company to merge with within the 24-month timeframe. If that happens, investors get their money back, but the share rights essentially expire worthless. Investors are putting their trust in the management team to find the right opportunity, and that trust comes with significant risk. The offering price per unit is $10, but what does that actually mean for a SPAC? A unit is actually made up of one ordinary share and one share, right, which can be exchanged for 1/10 of an ordinary share later on. So you are not just buying a share, you are buying into a future promise too. The company aims to raise $125 million from this offering. A big chunk of that money, $125 million, will be placed into a trust account. This is standard for SPACs. It's like a secured piggy bank for the eventual acquisition. The rest, about $2 million, is for operating expenses needed to find that perfect merger target. Now let's talk about the sponsor, Breeze Sponsor The LLC. They are the initial investors and have bought founder shares for a tiny amount, about $0.005 per S-share. This sounds like a great deal for them. But it means that if the company does merge, public shareholders will experience significant dilution. The founder shares are subject to lock. Up periods, meaning they can't just be sold off immediately, which is a good thing for stability. But the key takeaway here is that the sponsor has a lot to gain if a deal goes through, which could create some interesting incentives. Looking at the financial tables, we see that as of the 8th of September 2025, the company had a shareholder deficit of $22,250. This is normal for a company that has just been formed and has not started operations or made a business combination. The key number to watch here is the net tangible book value per S-share. Let's look at the dilution. The table shows that even with no shareholder redemptions and assuming the full exercise of the over-allotment option, the adjusted net tangible book value per S-share is around $6.72. When you compare that to the $10 offering price, it shows a significant dilution, about 33%. This means that for every $10 invested, the intrinsic value of the shares is initially much lower, primarily because of the founder shares bought at such a low price. The dilution gets even worse if many public shareholders redeem their shares. In the maximum redemption scenario, the dilution to those holding onto their shares can be as high as 97%. That is a massive hit, which highlights the risk for investors who bet on this SPAC successfully completing a deal. The company's strategy is to focus on global operations and technology, particularly in healthcare biotechnology, advanced manufacturing, robotics, artificial intelligence, and related sectors. They are looking for companies with an enterprise value between $400 million and $1 billion. Importantly, they seem to have a clear process for identifying and evaluating potential merger targets. They are highlighting their past success with BreezeEye, which completed a complex cross-border transaction with YD Biopharma. This repeat performance could be a strong selling point for them. It shows that the team has practical experience in navigating the SPAC lifecycle. It is super important to understand the conflicts of interest. The management team and sponsor make money if a deal happens. This can create an incentive to push a deal through even if it might not be the absolute best for all shareholders. Their fiduciary duties are to the company, but their financial interests are heavily tied to the completion of a transaction. The filing clearly lays out these potential conflicts, and investors need to read this section very carefully. The underwriters IB Capital LLC and I Banker Securities Incorporated are offering 12.5 million units. They also have an option to buy an additional 1.875 million units if there is high demand. The underwriting discount is 1.5% of the units offered to the public, which is a standard fee. There is also a lot of detail about lockup periods for insiders, meaning they cannot sell their shares for a certain time after the offering, which helps prevent market flooding. For us holders buying these securities, the tax situation is complex. It depends on how the unit is split between ordinary shares and the share rights, and whether the company ends up being a passive foreign investment company or PAFIC. This could lead to some adverse tax consequences. US holders might have fewer US federal income tax issues unless their income is effectively connected with a US business. It is highly recommended for investors to talk to a tax advisor. My analysis, so what is the overall story here? Breeze Acquisition Corp. I2 is a SPAC with an experienced management team that has a track record of success in the SPAC world. They have a clear strategy and focus areas for their business combination targets. However, like all SPACs, the risks are significant. The biggest ones are the challenge of finding a suitable target within the time limit, the potential for significant dilution for public shareholders due to founder shares, and the potential conflicts of interest inherent in SPAC structures. The dilution figures in the filing are quite stark, especially in scenarios with high shareholder redemptions. This means that for investors hoping for a quick flip or assured return, this might not be the play. Success here hinges entirely on the management team's ability to execute a smart acquisition and build value in the combined entity. The company's direction is set towards technology and healthcare, which are attractive sectors, but also highly competitive. The legal and tax complexities are substantial and must be understood before investing. Alright, that is our breakdown of Breeze Acquisition Corp. IIS-1 filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord in the description for more corporate insights and discussions. Thanks for watching. See you next time.